Inflation isn't an accident. It is a deliberate problem that is engendered by the government in conjunction with the central bank. So it's a government that overspends and has the central bank print money to monetize that debt. That is where inflation comes from. It's legal thievery is what it is. And as I just said, they weren't happy with 2%. Now they're thinking about, there's papers being written about the effectiveness of having an economy with a much higher inflation rate. And if their 2% target doesn't work and the 3% and 4% doesn't work, then they're just going to go higher and higher. The yield curve is saying very clearly, which is a component of my model, that we are heading in for not will we have a recession, or if we do, it'll be short and shallow. That's the mantra you get on things. You're going to have a very significant recession. That's what all the data that I have in my model tells me. That's the real moral hazard here. You are taking people who work their entire lives to save and have a very peaceful retirement because they can get a real rate of return on their investments. And you've taken that concept and thrown it out the window, and you've caused people to go back to work or be destitute because of their actions.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for December 6th through December 13th, 2022, while supplies last. This week we have a double feature on Canadian maples. 2022 silver maples are just $6.25 over spot, while backdated silver maples are just $6.05 over spot, while this shipment lasts. Silver maples are produced by the famed Royal Canadian Mint, and were the first silver coins to be minted at 4/9 fine purity. And they remain one of the purest, most respected, and most recognized silver bullion coins today. Again, the 2022 silver maples are just $6.25 over spot, while backdated maples are $6.05 over spot. They come in tubes of 25, monster boxes of 500, and are IRA eligible. If you'd like to learn more about a precious metals IRA, call us. We'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have this returning guest whom our viewers always look forward to hearing from. This is Michael Pento. He's the founder of Pento Portfolio Strategies. He joins us this Tuesday, December 6th, 2022. Michael, thank you for coming back on Liberty and Finance.
Always a pleasure, Dunnigan.
I wanted to start off by talking about inflation/deflation, because I know in your studies and your analysis and in your forward-looking indicators and everything, you really focus on that. And it's been something of major importance, major impact, and a great bit of confusion for many people who are paying any attention, because we've been told for years by the Fed that they had this 2% inflation target that they couldn't achieve, and now, whoops, we had transient. Whoa, it's over. Well, now it's more than transient, and it's staying high. And people from shadowstats.com, John Williams saying, it's a lot higher than you've been told for a long time, and other people saying, it's just, you ain't seen nothing yet. It's just going to keep on going for the sky because of supply chain fragmentation and food costs and energy, this and that. And other people saying, nope, now we're rolling over into deflation because look at housing is rolling over and car prices are finally coming down, and it's going to, we don't know which way we're going, most people. So Tim Carr asks, I would like to hear Michael's opinion on inflation. How long will it last? Will it get better or worse? When is deflation likely to start? Please.
Well, I could take 10 of these interviews just to pontificate on.
You only get one.
Yeah, but I could take the whole interview to answer that one great question. So I have the IDEX strategy, inflation, deflation, economic strategy. So we are in sector 2 right now, which is disinflation. That wasn't one of the choices you mentioned, right? So just the rate of change of inflation is slowing. I believe we're headed for outright deflation in the near future too. And I'll just explain why. I mean, inflation isn't natural, doesn't naturally occur. Stable prices would be, status quo, and then you would have deflation, which follows periods of bubbles. But inflation isn't an accident. It is a deliberate problem that is engendered by the government in conjunction with the central bank. So it's a government that overspends and has the central bank print money to monetize that debt. That is where inflation comes from. And the reason why we had inflation on Wall Street for many years following the Great Recession, from 2009 to 2020, we had inflation on around the canyons of Wall Street, because the central bank was creating base money supply, printing money, buying assets from banks, and banks would buy more assets, be it bonds, CLOs, and stocks. And that created inflation on Wall Street and on Main Street. I'm trying not to get too much in the weeds here, but I'm almost finished. So after 2020, when we had the outbreak of the global pandemic, then we had inflation both on Wall Street and on Main Street because we engaged in helicopter money. In other words, we circumnavigated the banking system and sent money directly to people and businesses. So the government borrowed money from the Fed and handed it directly to people rather than have it go through the banking system. They weren't relying on loans being generated from the primary dealers. So now what we have is what I feel, disinflation headed for deflation. I'll explain why. So for the first time in history, the money supply, as measured by M2, is actually shrinking. We've never seen this before. Year over year, M2 money supply, which is the largest aggregate now kept officially, is now shrinking. It was growing. I think it was in the 20s, 26% year over year at the high. So you're going from the rate of change there is from 20% to negative. And you also at the same time, banks, the aggregate amount of banks tightening lending standards and making loans is now higher. So you have more banks not lending money out. And at the same time, you increase the cost of borrowing from 0% to 3.8 where it is today. It's going to 5%. My belief is around 5% by March. And you are burning that base money supply now at the pace of $95 billion a month. So given what I just said, shrinking money supply, banks no longer creating money through the debt monetary system as they were in the past, shrinking base money supply, how could you have anything but disinflation and then deflation? You'll see that I'm correct, because it's not magic. It's not a genie. It is about the psychology behind where the fiscal and monetary authorities are heading. And it is all about now the shrinking of credit. Sorry if I went too long, but
no problem.
You throw a question like that at me, and I'm not going to say, "Oh, it's I feel that's the supply chain is." And I feel no, it's not what I feel. It's what's happening in the math. How much money are banks lending? What is happening with the money supply? And what is the central bank doing with the base money supply? Okay, which is called high-powered money, and that all equals one thing: deflation.
Okay, so you've talked about the driving factors that affect inflation. What do you see that ordinary people will experience in their lives in the next couple of quarters because of where we're at in that transition from inflation to disinflation to deflation?
Well, we've seen a pretty significant deflation already in asset prices. And that's primarily bond prices have come down. As a matter of fact, I want to just quickly add that if you bought the risk-free asset of a long-duration treasury bond, you're down about 30% this year. So that tells you a little bit, bond prices down, yields go higher. So you had deflation there. You've had deflation in equities. But even though you've had deflation in equities, and you can pick your, depending on when this recording is going to be released, we're down 25, 20, 25, 30%. If you look at the S&P and the NASDAQ, the Russell, depending on your index, come down a long way. But even though we're down significantly on equities, we still are today higher in valuation than at any other time in history from the signing of the Buttonwood Agreement, which created Wall Street, all the way to 2020. So pre-pandemic, all the way to the signing of the Buttonwood Agreement, we have never seen asset prices this high, the valuation of equities. And I'm particularly commenting on two things, the two best metrics, which is a total market cap of equities as a percentage of the underlying economy, GDP, and price to sales, not price to earnings, I'm talking about the market price to revenue, because you can't really fudge revenue unless you're just lying. Gap earnings, by the way, are shrinking, but the pro forma better than expected BS that you get on Wall Street will obfuscate the real number. So that's where we are now facing with not only deflation in the money supply, but now we're going to have deflation in three of the triumvirate of bubbles that were created by central banks globally, which is, we already got the bond bubble breaking. I think that's mostly over. We're in the middle of the stock market bubble, and now we're going to have the real estate bubble pop too. You have what I think is a depression brewing in real estate. And I'm just going to give you a couple of numbers behind it, because I never like to just talk about things without going into my very awkward way of explaining things with numbers. So in the 4 years leading up to the Great Recession and the bursting of the real estate bubble, if you look at the S&P Case-Shiller Home Price Index, it increased by 50%. Okay, so from 2002 to the apex of the bubble, which was 2006, the summer of 2006, real estate prices went up 50%. Well, guess what? From 2018 to 2022, real estate prices went up 50%. You've had the same increase, but the level of home prices now, the index now sits at 300. At the peak of the bubble, it was 183. So we're not only the same amount of increase heading into the Great Recession and the real estate bubble, the same percentage increase over the preceding 4 years, but the level of home prices is astronomically higher than it was in 2006. So people will say, well, the underwriting standards are better, and I completely concur. The ninja loans are for the most part on, no dots, no income, have all the money. Hey, can you fog a mirror? You know the story. But 25% of all real estate purchases last year were done by Wall Street and investors. 1/4 were purchased by home flippers. Now the calculation goes like this. Well, if I'm buying an asset that's going up 20% a year and I can rent it out at higher and higher prices, woo, this is great. I put down, 10, 20%. If it's a mortgage that's a conforming mortgage, you can put down less than 20%. Get away with that. Wasn't zero, but you can get around 3%, 4%. That's out there too. But even if you put down 20%, so you're qualified. But then the calculation is, wait a second. My renters are losing their jobs, so I've got a problem collecting rent, and my principal is going down. And now I have to carry all the carrying costs associated with maintenance and real estate. So then you're going to see 1 out of every 4 houses have the potential to be dumped that were purchased in the boom in 2021. So what I'm saying is, yes, their underwriting standards are better, so you won't have, mom and pop dumping their house because they didn't put any money down on it, but you'll have Wall Street selling it because it no longer makes financial sense to carry an asset that's depreciating. So you have all 3 bubbles bursting. That's the deflation that I see coming in 2023. It's potentially very, very devastating in the short term, but exactly what we need to reconcile these grand imbalances that have been created by fiscal and monetary largesse.
You talked in that discussion about the helicopter money, the issuing of bailout checks and that sort of thing to not only individuals but businesses over the past 2.5 years. There's another major action that's expected from the Fed or the Treasury, and that's the idea of a central bank digital currency that would, and you've talked to us about this in the past, you've called it Fed coin, and you've talked about different aspects of it. Selected Silver Sire has a question. Please discuss the pitfalls of CBDCs so I can share it with less educated friends. Do it in layman's terms, please.
Okay. I have a problem doing that. Everybody tells me I have a problem doing that, but I'll try my best. I see the danger, the primary danger that I see, there's 2 dangers. Number one is there's no alternative to hoard money from private individuals. So if I am being charged at a bank a negative interest rate, in other words, if I deposit my money at the bank, it's $1 million, and now the bank's going to tell me at the end of the year you're going to have $900,000. So your negative interest rate is 10% per annum. I have a choice. I could take my money out of the bank and buy something of an alternative like physical gold. But if they tell me that I only have something called a digital currency, in other words, the only medium of exchange that's accepted is now a digital currency, then I have no alternative. I can't take my money out of the bank. In other words, I am subject to whatever negative interest rate the powers that be decide to put on it. Now, the other problem I see is that when you have a central bank digital currency, is that you obviate or preclude or eliminate the fiscal authorities. In other words, if the Fed gives everybody money in their digital wallet, okay, then we don't have to worry about Congress coming to some conclusion about passing a law to cut taxes, raise taxes, or give a stimulus check to people. The Fed can arbitrarily, unilaterally, theoretically, say, you know what? I want to increase inflation. I want to get spending going. I will just give people, it's my coin. It's a central bank digital currency, right? So the interest rate that's ascribed to that money is there under their purview. And the amount that they can give you is under their purview. There would be, I would think, nothing stopping that. That's a potential danger. So those are the two reasons why I really dread the day of having a central bank digital currency, because the power that government has over your money will be plenary, complete, total, and absolute.
I think people just don't understand. It's certainly a strange concept because we've grown up for many, many, many generations. I guess it's throughout most of human history with the idea that you can, if you work or create something of value, then you can capture that value into something that's real, like gold or silver, coin, put it in your pocket or your purse or whatever, and you're holding it, and you can use it if you need to for an emergency or an opportunity. You can hand it down to your kids or have it for a rainy day, that kind of thing. But this idea that you don't really have money anymore once you make this transition to a fully digital CBDC, you just have basically credits at the company store. And you can, as long as they remain there, because there's talk of expiring if you don't use them, use it or lose it, or negative interest rates, or
that's negative real interest rates. It's saying, hey, listen, you have two choices: either lose your money in the bank through your negative interest rate, or you can consume something. So in theory, you can get the supply of money higher, and you can control the velocity thereof. You could highly influence the velocity thereof, not just by the interest rate ascribed to it, but by the fact, the incentive of you're going to lose it if you don't use it. So, what would you do? You would buy something, you would hoard as many things as possible. That's a recipe for hyperinflation, because people don't, this is what the governments really don't get it. They don't understand this. You have to have an incentive to produce something. If you know that your production, whatever you produce, is going to lose value, why would you produce it? So you end up with shortages. This is what's going to happen in my opinion. God forbid if it does happen, but if we do go down that road, that's what's going to happen.
That's another thing you didn't touch on, but maybe we should, and that's the psychological. You did talk about some of the psychological impacts of realizing that you can't take your money out of the bank, so you're going to try to spend it real quick on real things. But the other one is this source of hopelessness and depression, which we've certainly seen in communist countries like Soviet Russia, places like that, where people the productivity goes right down. Why bother? Why bother starting a business if you're not going to be able to save up the fruits of that business for yourself and for your children and grandchildren? Why bother working hard at a second job or trying to be super efficient and getting a lot done so you can earn? Because everything you earn is going to be taxed or taken or out of your control.
This is the reason why the Laffer curve. If you tax people at 100%, your production is zero. No one's going to work. But the same thing with wage and price controls. If you tell me I can't produce a carton of eggs for a market price where I can actually make money at doing it, because the inflation is higher than the price control, then I stop producing eggs. What does that do? That limits the supply of goods as the amount of money in circulation increases. So prices go much, much higher. Too much money chasing fewer and fewer goods. That's what happens when we abandon. There's a reason why we had a gold standard in the heyday of this country. It makes a difference if what you produce means something. If our first form of money was barter. Okay, I produced something, and then it got a little clunky when we exchanged it, but I knew my production had value. And then we exchanged some of that production for gold because the mine supply of gold is limited. It was 1-2% per annum, and you couldn't change that. I mean, because as you went, technology got better, you had to go deeper and deeper. It cost you more and more energy to extract that same amount of gold from the ground. It was very limited in supply. It was virtually indestructible. Those two things are, that's not Bitcoin. Bitcoin is not limited supply. I don't want to get into cryptocurrencies. There you go, Michael. You're opening the door. But there's an unlimited number of blockchains that can be created and coins that can move along that blockchain. So is Bitcoin, Ethereum, or all the rest serve the same primary purpose. It's a coin that moves along a blockchain. Unlimited number of those things you can produce. You can't produce an unlimited amount of gold. It's the explosion of a star, and it's in the earth. I heard somebody just read a comic relief. Someone said, "Well, there's an unlimited amount of gold on this." Go ahead, go get it. Tell me what the cost is going to extract an ounce of gold from this asteroid, and then if you can sell it at a profit, God bless you. Gold will be a lot higher than $1,800 an ounce. I can tell you that.
You've talked about some really important principles, one of which was the interference of government and the Fed and so on in people's lives, including their business lives, that's affected businesses. Actually, we've had just astronomical numbers of business closures where people were locked down and their business failed, that sort of thing. Or there was winners and losers picked by government who were favoring big box stores over small mom and pop shops, that sort of thing. There's also been geographic disparities between different jurisdictions within the U.S. or between different countries, with some jurisdictions being extremely restrictive on individuals and on businesses, and others being much more freedom-oriented, liberty-oriented. There's a question here from Otto Dictata who says, Michael, why the heck are we still in New Jersey after all? Are we gluttons for punishment? How was your experience setting up shop in Florida versus New Jersey?
Well, I can tell you that I actually came down here with the family, rented for a year so I can explore the area. And while I was renting, the home price that I eventually bought went up by 100%, almost 100%. And the reason is that everybody was coming to this bastion of, they call it freedom, and I call it the great state, the free state of Florida. So there's our great governor, Ron DeSantis. So people didn't want to be subject to lockdowns with the COVID virus, and they wanted some freedom to operate their business. I mean, you don't have that in parts of this country. New York, California, and we were pulling people from all over the United States down to Naples. So I'm glad I made the change, and hopefully we can maintain Mr. DeSantis here for as long as possible before he runs for president.
Your thoughts on how much difference it's actually going to make for people who have either their livelihood, their business, whatever, in a state like Florida or Texas or these other states that are kind of standouts, maybe South Dakota, for supporting more freedom than other states. Do you think it's going to make enough of a difference, or do you see changes like the CBDCs and other things that are global or national in nature preempting and these local differences?
Yeah, well, that would supersede anything that done. We have a great governor here and a great state, but it doesn't affect the laws of the nation. So, and also the central bank. I mean, the central bank right now is sort of found their monetary manhood and is aggressively hiking interest rates. The fastest rate of change in history, 0 to 5% year over year from March of 2022 to March of 2023. You'll have 500 basis points of rate hikes in conjunction with 95 billion of quantitative tightening. So that's never happened before. So that's gonna predominantly supersede anything that's happening here with the fact that we don't have any state income tax. Well, that's very, very beneficial. But what happens in response? Because even Chair Powell said this, and I couldn't believe my ears when he said it at the last press conference. By the way, if you want to talk about the difference between the press conference, his last press conference, and his interview at the Brookings Institute, we should get into that.
Yeah, please.
But he said that, and amazingly, he said, if we get into trouble with deflation and a problem in the credit markets, well, we'll just go back to what we know how to fix that. Just go back to zero, and we'll start printing money. And I was like, my mouth was agape. I said, I can't believe he just said that. Now, prior to engendering the highest inflation we've ever had in the history of the nation, that's if you calculate it correctly, we were 20%. If you calculated pre-Boskin, we were 20%, not just a few months ago. But prior to getting, remember, to 20%, Powell could not get to 2% the way they measured inflation.
Mm-hmm.
So his mantra at that point was, well, we know how to tackle inflation, so we're not worried about doing too much. We can always just shut down inflation. The problem is we need to get to a sustained level of 2% or higher for a period of time. Well, he vaulted over 2% and went to 20%, right? So, and now he's saying, well, we know we know how to fix the problem of deflation. It's, we just have to tackle inflation right now. So it's like, you're so duplicitous, full of hypocrisy. Do you even listen to what you're saying? I mean, at what point is the Federal Reserve, talk about the importance of what we do nationwide over what we do at states. When is the Federal Reserve going to acquiesce and assent to the notion that money supply should be commensurate with the natural growth rate of the economy? So money supply should grow commensurate with the 2% potential growth rate of the economy, which is simply labor force growth plus productivity. So that magic number, it's 2. It's not 2% inflation. The natural rate of inflation is 0 because you're having money supply grow commensurate with the economy. But he somehow turned that into an argument about, hey, if we have 1.99% inflation, it's just no good. The economy can't function unless it's at least 2, don't you? So that's the problem that I see. The Fed is lying to itself. It has a very difficult time controlling inflation because inflation is psychology. It's the market's psychology of the value of the dollar, which is, of course, it's a derivative of what the central bank is doing as far as destroying or protecting the money supply.
Before we get off this point, because you've touched on something very important here, could you talk to us about this policy notion of more than 0% inflation at all? I mean, because what do you believe are and again, back to the ordinary person, the ordinary small business owner or the ordinary individual who's a saver, an earner, a retiree, of an inflation target other than 0 by our monetary authorities?
So great question. So price signals are extremely important because if I don't know what the price of things are going to be, I have a very hard time deciding what to produce and what to consume, consumers and businesses. But when you tell me that the economy doesn't function well unless it's a 2% rate of inflation, and then have a very miserable time achieving that, and it goes from basically under 2% to 20%, now I'm very confused as a business person, because the most important price signal you can get in a free market economy is the value of your money and the cost of money. So if I don't know what the cost of my money, if it's going to be 0 and then it's going to be 5 or 6, and then the money supply is going to go from growth rate of 0 to 20 to a negative rate, I have a very hard time deciding as a business person what the inflation rate is going to be in the future. And that's just more friction that comes to the private sector.
How about for individuals that are earning and saving their life savings and their retirement and that sort of thing, of inflation at all, inflation other than 0%? How does that affect ordinary people? Every dollar they've got in their pocket or their wallet or they're under the mattress or in the bank or whatever.
Well, it's real interest rates. So the idea of an investment is a real after-tax return. And you can get that at 0%, you can get it at 6%. The problem is you have a long period, a long duration where real interest rates were negative. So you have people who work their entire lives, Donegan, and they made an assumption. They said, well, I can get X% from a municipal bond, which will, after taxes and after inflation, get me a real return of 1 or 2%, which means my purchasing power and my standard of living can be maintained, or maybe even increase a little bit, what a novel idea. But when you have a condition of negative real interest, your standard of living is forced to decline. So if I buy a municipal bond where after tax return is negative, and because I'm retired, I have to have a level of safety. So my calculation is I can lose money every year. Every year, my purchasing power is going to be declining because the rate I'm getting on my investments is lower than inflation. Guess what I have to do? And even if I'm a pension fund, I can't buy treasuries, risk-free assets, and I can't buy municipal bonds. You know what I have to buy? I have to buy junk bonds, and pension plans have to buy Bitcoin and Ethereum, and then they invest in, bankrupt and fried, the FTX exchange, and guess what? They're now bankrupt. That's the real moral hazard here. You are taking people who work their entire lives to save and have a very peaceful retirement because they can get a real rate of return on their investments. And you've taken that concept and thrown it out the window, and you've caused people to go back to work or be destitute because of their actions. Sorry, that's the truth. Sorry if it's uncomfortable for some people to hear, but that's the real damage of having the plenary authority of a central bank who wants to not, instead of introspectively say, gee, I am not God, I am not omniscient, I do not know what the cost of money should be at all times. I cannot control this most important signal pricing in the economy. I'm going to retreat with my power and influence over the economy. Now we're talking about a Federal Reserve that's waxing towards increasing their power and influence over the economy by mentioning things like not only a central bank digital currency. There's people in the Federal Open Market Committee who are talking about raising that 2% inflation target. How dangerous could that be? I mean, how convenient. Why don't we just raise? Well, a core PCE is 5% right now. Let's just raise it to 5 and call it a day. We're successful. Well, if you do that, you're going to have inflation go from 5% back to 20 to 5 to 50%. You can end up getting into a tractable hyperinflation if you're going to change the definition of what stable money is based upon your inconvenience about being able and incompetence in achieving it.
We had a client seriously suggest that we stop calling it an inflation target and just call it central bank theft. What is your opinion of the accuracy if we started calling, instead of the Fed saying they have a 2% inflation target, and they're talking about that on the evening news and everything, what if they said we have a 2% central bank theft target? How accurate or inaccurate do you think that is for savers?
It's very accurate. It's legal thievery is what it is. And as I just said, they weren't happy with 2%. Now they're thinking about, there's papers being written about the effectiveness of having an economy with a much higher inflation rate. And if their 2% target doesn't work and the 3% and 4% doesn't work, then they're just going to go higher and higher until it's like moving the goal line. I mean, when you get to the goal line, you've achieved your target, but they keep moving it to suit their needs. So now the goal line's the 20-yard line. So hey, we couldn't supply you the consumer with stable prices. So we're going to leave you with inflation right now, which real rate of inflation is probably, 15. It's probably in the teens right now, year over year. So we couldn't give you price stability, so we're going to just be happy with that. And what are the implications of that? What's your next step? You're going to say you're going to stop raising interest rates and you're going to stop draining the balance sheet? So you're going You're going to be left with a balance sheet that's $8.5 trillion when it was $800 billion in 2007. Is that what you're going to do? And then hope that things don't go out of, the first-time home buyers have been priced out of the real estate market. They're renting, and it's killing their incomes, or they're having to move with family and friends. This is a destructive practice of, home prices. A real estate property doesn't naturally go up 20% per annum year over year. That's what's happened in the last 2 years. That's not by accident. That's because the Fed printed trillions of dollars and bought mortgage-backed securities to take the interest rate on mortgages down close to 3%. That's why. And then Wall Street has the idea, oh, listen, if I can borrow money at virtually almost nothing and buy 25% of all single-family homes, isn't that wonderful? And then I'll do you a big favor. I'll rent them back to you, Mr. and Mrs. The lower two quintiles of the population.
Yeah,
I'll rent it back.
Gets us back
at rates
to
you can't afford.
You'll own nothing and be happy because we said so. So a lot of what you're talking about, but the hubris and the overreach and the interference of these policymakers in markets raises this next question. It leads into this next question from Bill M. from Florida. Michael, same question I have every time. Do you still believe in using models to predict outcomes from a financial system that is looking more and more corrupt and failing every day?
It's the best. It's the best thing that I have. I mean, what else can I go through? Headlines and feelings. Should I go off of CNBS's Pro Week? They have this guy on. My next commentary, I don't want to embarrass or disparage anybody. I make plenty of mistakes. We're all human. But to pay somebody as a contributor and have them on as a Pro Week, who predicted Bitcoin was going to $200,000 a unit by the end of this year, this is the kind of advice that you should be getting? No, I have a model that analyzes the economy like a scientist would. I look at 20 arcane components that let me know things that are specifically related to the second derivative, the rate of change of inflation and growth. And that's the best that I have. And I know that people lie. And I know that, like, for example, can I give you a quick example, is we had the release of the non-farm payroll report from the Bureau of Labor Statistics. And the establishment survey, which is based on a birth-death model, showed 268,000 net new jobs were created in the month of November. Okay, that's not a lie. That's their model they use. But if you look at other things like the work week shrank, aggregate hours work shrank, the household survey showed 130-something thousand people lost their jobs, and there hasn't been one net new employee since March of this year added to the payrolls, according to the household survey. So, not only do people lie, but you have a lot of bad information. But my model incorporates things like the yield curve, the yield spread, the 10-2 Treasury yield spread is now the most negative it's been since 1981. Okay? So that's over 40 years of data. And we all remember the recession of, we all remember, we should study it if we don't know, where inflation was very high and unemployment was double digits, over 10%. The economy was shrinking. You couldn't even find a job. You were lucky. When I was a kid in 1981, I was ecstatic. My parents were even more ecstatic that I found a job at Burger King. You couldn't get a job. A teenager could not get a job in 1981. There was no jobs available. That's how bad that it was. A very, very bad recession/depression. But the yield curve is saying very clearly, which is a component of my model, that we are heading in for not a will we have a recession, or if we do, it'll be short and shallow. That's the mantra you get on mainstream media. You're going to have a very significant recession. That's what all the data that I have in my model tells me. I look at break-even spreads. I look at net banks that are tightening credit standards. I look at the yield curve spread. I look at 20 components that tell me that we're headed for disinflation, deflation, recession. And if we don't have a response, because the inertia behind a recession is very, very powerful. If we don't have a response, a capitulation, a real pivot by Powell, I hope he doesn't, because we do need a severe recession to reconcile these imbalances. But if they don't, we're going to have a very significant and well-deserved, well-earned, and well-needed recession in 2020. Could even be a depression if all things were equal.
Before we let you go, I wanted to ask this question from Paul Griesbach, who says, you have said to hold some cash and then go into gold when it bottoms, but is this even going to be possible for a little guy, or will it just not be available? So I guess two parts of the question. First part is, where are you at as you look forward into this progression of when does precious metals play into your
when was the
model?
last time I was on?
About a month and a half ago.
So about 3 weeks ago, 2 or 3 weeks ago, I did increase my physical allocation of gold, and I did buy miners for the first time about 3 weeks ago. I don't have the exact date offhand, and it turned out to be a good move. My calculation is very simple. Gold is, a very key asset class to own. My calculation is only concerned about one thing: the direction of real interest rates, and nominal rates have now finally started to fall and roll over because of the recession. That's the people who really understand what's going on are starting to buy duration bonds now, because the Fed is going to have to stop raising rates, in my opinion, in the first quarter of 2023. Nominal rates are starting to come in out along the yield curve because of the dramatic slowdown. I see significant slowdown in the economy. That means when nominal rates are falling, it makes it a lot easier for real interest rates to fall, unless you're in a rapid deflation. We're not in that yet. We just have disinflation. So real interest rates are falling, and gold loves two things more than anything: recession and falling real interest rates. And we're heading towards that sweet spot. I don't know how long it's going to last. I'm not sure if there's going to be a liquidity crisis, which actually hurts gold. But right now, I have, I think my allocation to gold, I doubled my allocation to physical and precious metals, physical gold and miners. And I believe we're about 10% now in the portfolio, maybe a little higher, from almost nothing.
Michael, we always appreciate your visits here, and it's funny, no matter how often we do have you on, we get told to have you on more often. Buck Rogers says, thanks, DK, for bringing back the most down-to-earth analyst. And let's see, I've got another one here. Lofty Ken says, Pento rocks, and I could go on and on. So anyway, we ask for questions, and we get accolades and gratitude from our viewers for having you on. We're grateful for that. If people want to follow your work and talk to you about how you can be more involved in their personal financial lives, how can they get a hold of you?
Well, if you're a U.S. citizen and you have about $100,000 to invest, I'll personally manage your money for you at mpento@pentoport.com is my email address. The website is pentoport.com. And if you don't have that and you just want to subscribe to a podcast, it's $50 a year, which I give every week. I give you the information and data that you absolutely need to have to make, hopefully, very good decisions about your own personal finances. So I encourage people to go to the website and subscribe to either one of those services. And oh, by the way, turn off the channel and turn off the mainstream financial media, because it's just absolutely horrific what they're my model has never missed an economic downturn, a negative liquidity cycle. They have never predicted one. I mean, the preponderance of their talking heads are even today telling you that we're probably going to be able to avoid a recession and have a soft landing. Well, I would say that the odds of that are close to zero. Not zero, very close.
Well, Michael, we're always grateful for your presence here with us. So on behalf of all of our viewers, thanks for joining us again on Liberty and Finance.
Thank you, Donovan. God bless.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.